Hi there. Welcome to our channel, The Roaming Investor. Today, we're going to talk about how to lower your tax bill and increase your investment returns. We'll share valuable tips and strategies for maximizing your salary and minimizing your tax burden. From increasing your pre-tax retirement contributions to taking advantage of tax credits and deductions. We'll also explore the benefits of tax-efficient investments and provide expert insights on how to make informed financial decisions that align with your goals and circumstances. Whether you're just starting to build your wealth or looking to take your finances to the next level, this video has something for everyone. So, join us as we unlock the secrets to lowering your IRS balance and increasing your investment returns. Before we get started, it is important to subscribe to our channel if you haven't and hit the like button to support more content from this channel. 1. Increase your pre-tax contributions to retirement accounts. One of the easiest ways to lower your IRS balance is to contribute more to your pre-tax retirement accounts, such as your 401k or traditional IRA. These contributions are deducted from your taxable income, which can lower your tax bill and increase your returns. Increasing your pre-tax contributions to retirement accounts is a great way to lower your IRS balance and increase your returns because it allows you to save money on taxes while also setting aside money for your future retirement. Let's say you earn $100,000 per year and contribute $5,000 to your 401k plan. If you increase your contribution to $10,000, your taxable income would decrease to $90,000. This means you would pay less in taxes, and your IRS balance would be lower. Additionally, the money you contribute to your 401k will grow tax-free until you withdraw it in retirement, which can help increase your returns over time. Another example is a traditional IRA. Let's say you earn $80,000 per year and contribute $5,000 to a traditional IRA. Your taxable income would decrease to $75,000, which can lower your tax bill and increase your returns. Additionally, the money you contribute to a traditional IRA grows tax-deferred until you withdraw it in retirement, which can help increase your returns over time. It's important to note that there are limits to how much you can contribute to these accounts each year, so be sure to check the current contribution limits before making any changes. 2. Take advantage of tax credits. As your salary increases, you may become eligible for tax credits, such as the Earned Income Tax Credit, which can help lower your IRS balance. Taking advantage of tax credits is a great way to lower your IRS balance and increase your returns as your salary increases. Tax credits are different from tax deductions because they directly reduce the amount of taxes you owe, whereas deductions reduce your taxable income. One example of a tax credit that can be particularly helpful for lower-income individuals and families is the Earned Income Tax Credit, EITC. The EITC is a refundable tax credit that is designed to help low to moderate income workers keep more of their earnings. As your income increases, you may become eligible for a larger EITC, which can help lower your IRS balance and increase your returns. Another example of a tax credit is the Child Tax Credit, CTC, which provides a tax credit of up to $2,000 per child under the age of 17. As your family grows and your income increases, you may become eligible for a larger CTC, which can help lower your IRS balance and increase your returns. There are many other tax credits available, depending on your circumstances. You may be eligible for the American Opportunity Tax Credit if you are paying for higher education expenses, or the Child and Dependent Care Credit if you are paying for child care expenses. There are also tax credits available for energy-efficient home improvements, such as installing solar panels or upgrading your heating and cooling systems. To take advantage of tax credits, it's important to research the credits that you may be eligible for and keep good records of any expenses that qualify. Some tax credits have income limits or other eligibility requirements, so be sure to review the rules carefully to ensure that you qualify before claiming the credit on your tax return. 3. Itemize your deductions. If you have a lot of deductible expenses, such as mortgage interest, charitable donations, and medical expenses, you may want to consider itemizing your deductions instead of taking the standard deduction. This can help lower your taxable income and reduce your IRS balance. Itemizing your deductions is another strategy to consider if you have a lot of deductible expenses. Deductions are expenses that you can subtract from your taxable income, which can help lower your tax bill and increase your returns. The two options for taking deductions are itemizing your deductions or taking the standard deduction. If you have a lot of deductible expenses, such as mortgage interest, charitable donations, and medical expenses, you may be able to lower your taxable income by itemizing your deductions instead of taking the standard deduction. When you itemize your deductions, you list all of your deductible expenses on Schedule A of your tax return. For example, let's say you own a home and paid $10,000 in mortgage interest and property taxes last year. You also made $2,000 in charitable donations and had $3,000 in medical expenses that were not covered by insurance. In this case, your total deductible expenses would be $15,000. If you take the standard deduction, your deduction would be $12,550 for single filers in 2022. But if you itemize your deductions, you could deduct the full $15,000. However, it's important to note that itemizing your deductions can be time-consuming, and you will need to keep good records of all of your expenses. Additionally, some deductions have limits or phase-outs based on your income, so be sure to check the rules carefully before deciding whether to itemize your deductions. 4. Invest in tax-efficient funds. If you invest in taxable accounts, consider investing in tax-efficient funds, such as index funds or exchange-traded funds, ETFs, which have low turnover and generate fewer taxable events. Investing in tax-efficient funds can be an effective way to reduce your IRS balance and increase your returns over time. Tax-efficient funds are mutual funds or exchange-traded funds, ETFs, that have a lower tax liability compared to other funds. Since index funds are passively managed, they have lower turnover and generate fewer taxable events, which can help reduce your tax liability. Similarly, ETFs are often more tax efficient than mutual funds because they are traded like stocks and do not typically generate capital gains. If you invest $10,000 in a mutual fund that has a turnover rate of 100%, the fund will buy and sell securities frequently, which can generate short-term capital gains that are taxed at a higher rate. If the fund generates $1,000 in short-term capital gains, you would owe taxes on that gain, which could increase your IRS balance. But if you invest in an index fund or ETF with a lower turnover rate, you may be able to reduce your tax liability and increase your returns over time. In addition to index funds and ETFs, there are other tax-efficient investment strategies, such as tax loss harvesting, which involves selling losing investments to offset gains from other investments. This can help reduce your taxable income and lower your tax liability. 5. Consider a Roth IRA. If you expect your income to continue to increase, you may want to consider contributing to a Roth IRA instead of a traditional IRA. Roth IRA contributions are made with after-tax dollars, but the earnings grow tax-free and qualified withdrawals are tax-free, which can help increase your returns and lower your IRS balance. Contributions to a Roth IRA are made with after-tax dollars, which means that you don't get an immediate tax deduction like you would with a traditional IRA. However, the earnings in a Roth IRA grow tax-free, and qualified withdrawals are also tax-free, which can help increase your returns and lower your IRS balance in retirement. One advantage of a Roth IRA is that it can be a good option if you expect your income to continue to increase. If you expect to be in a higher tax bracket in retirement than you are now, a Roth IRA can provide significant tax benefits. By contributing after-tax dollars now and allowing your earnings to grow tax-free, you can potentially save on taxes in the future when you withdraw funds from your Roth IRA. If you contribute $6,000 per year to a Roth IRA and earn an average return of 6% per year, your account balance could grow to over $500,000 by the time you reach retirement age. With a traditional IRA, you would have to pay taxes on your withdrawals in retirement, which could reduce your overall returns. With a Roth IRA, however, you can withdraw your earnings tax-free, which can help increase your returns and lower your IRS balance in retirement. It's important to note that there are income limits for contributing to a Roth IRA, and the contribution limit is currently $6,000 per year, or $7,000 per year if you're over age 50. It's also important to consider your individual financial goals and tax situation before making any investment decisions, and consult with a financial advisor or tax professional if you have questions or concerns. These professionals can provide valuable guidance and expertise in areas such as tax planning, retirement planning, investment management, and estate planning. They can also help you take advantage of tax credits and deductions that you may be eligible for based on your income and expenses. Similarly, a financial advisor can provide guidance on building a diversified investment portfolio that aligns with your risk tolerance and long-term financial goals. They can also provide advice on retirement planning, such as how much you need to save for retirement and when to start taking Social Security benefits. It's important to choose a professional who is qualified and experienced in the areas you need assistance with and to ask questions and seek clarification on any topics you're unsure about. Let me know in the comments what other ways you find useful to save on taxes that we should add to this list.
If you're enjoying the content on this channel, please take a moment to hit the like button and subscribe to stay updated on all the latest videos. By doing so, you'll be helping to support the channel and keep us motivated to create more great content for you to enjoy.